Welcome to this Economic Roundtable hosted by Asia Pacific Economics on the escalating economic impact of the Middle East war on the world economy and financial markets. The disruption to the world oil and LNG markets has become increasingly protracted, with very limited oil flows through the Strait of Hormuz, through which 20% of world oil shipments transit during normal conditions. I will discuss these global shocks with Rajiv Biswas, CEO of Asia Pacific Economics. But before I do, please like and subscribe to help us continue to share the latest information. Rajiv, how severe are the disruptions to world oil and gas markets, and what are the implications if this conflict does not end soon?
Thanks, David. I think when we look at where we were in 2025, that was a very different situation to what we're now seeing. Back in 2025, it was a short, sharp strike that ended quickly, and it didn't disrupt oil flows crucially. Whereas this time around, what we're seeing is a much more protracted conflict, much more widespread in terms of missile attacks by Iran on other countries in the neighborhood, particularly GCC countries. And crucially, we've seen the significant disruption of oil and LNG flows through the Strait of Hormuz, which has been largely shut for shipping in recent weeks. So the consequences of this current conflict are far more extensive and damaging to the world economy the longer this goes on. The longer it continues, the more the disruptions will escalate in many areas of downstream industrial production that are reliant on those flows of petroleum and LNG through the Strait of Hormuz. Iran has been allowing some limited movement of oil through the Strait of Hormuz for countries that it has a good relationship with. And in particular, China has seen millions of barrels of oil coming through the Strait of Hormuz in the past several weeks because Iran has allowed that. Over the weekend, we also saw that India was able to get permission for several LPG tankers to go through the Strait of Hormuz, which is a form of fuel that's quite important in developing countries, like particularly in South Asia and in some countries in ASEAN as well. So that was quite an important alleviation for China and India that we've already seen. However, clearly this is going to be much, much less than the total normal flows through the Strait of Hormuz. And we have seen that Saudi Arabia has ramped up its shipments through the East-West pipeline to the Red Sea port of Yanbu. And they're already loading some very big tankers there, which would at least partially mitigate the disruption through the Strait of Hormuz. But the risk, of course, is that geopolitics are also a threat in the Red Sea. So far, the Houthi rebels in Yemen haven't said that they were going to attack the shipping again. But of course, there's still uncertainty about whether that will be sustainable or whether the Houthi rebels might again start to attack shipping, given that they do have strong ties with Iran. So there's a lot of uncertainties about how much oil will actually be able to come from the Gulf countries through to the rest of the world. So I think fundamentally we do need to see some kind of mediated agreement that will allow the normal flow of oil through the Strait of Hormuz, because these alternative routes, first of all, don't allow sufficient shipments of oil to offset the Strait of Hormuz shipments, and also, of course, are also subject to the risk of geopolitical upheaval at a future point in time.
Now, you mentioned the downstream industries. Would you like to get into a little bit more detail about the consequences to the downstream industries, particularly in the Asia Pacific region, that are reliant on the commodities and products that are normally shipped through the Strait of Hormuz?
We're already starting to see quite significant disruptions because of the closure of the Strait of Hormuz, with force majeure already having been declared early on in the conflict by Qatar Energy, which has completely stopped shipments of LNG through the Strait of Hormuz, and that's already 20% of world LNG production. So that's already a very big disruption that's starting to have ramifications for global LNG markets. But
Hmm.
also many other products that come through the Strait of Hormuz are potentially no longer coming through. For example, urea, which is very important for global fertilizer production, and so very important for agricultural production. And of course, all the downstream products of oil are crucial for manufacturing. And that's very important for Asian countries because Asia, of course, is the factory of the world. If they can't get their feedstock from the Middle East, then they have to either curtail production or stop production. And that could significantly disrupt production of many petrochemical products that are essential inputs for manufacturing across a wide range of sectors. And we've already seen force majeure being declared by several petrochemicals manufacturing companies
Hmm.
in Asia, in Singapore, in Indonesia, in India. Also, we've seen some force majeure declarations because of the disruption of inputs. We already have seen prices rising for some of these important downstream products. For example, aviation fuel is a refined product that's now also starting to be a concern because some countries that are big refiners of basically oil, turning it into refined petroleum products, are becoming concerned that they may not have sufficient supply domestically. So several countries are already considering curtailing their exports of refined products, which
Hmm.
then creates considerable disruption for other buyers across the Asia Pacific. So these sort of concerns are increasingly at the forefront. And the consequences of these disruptions are that we'll see more inflationary pressures, not just in oil and LNG prices, which already have surged, but also in many downstream product prices and the end consumer products as well, because if the consumer has to pay for higher transport costs, higher diesel fuel costs for road haulage, and for higher production costs for various consumer goods, then of course that also flows through to retail CPI inflation. And I think that is also now increasingly a concern as
Hmm.
this disruption becomes more and more protracted.
And so far, how severe have these shocks been to the world financial markets?
I think when we look at global equity markets, the response so far has probably been not as extreme as perhaps one might have expected. It's been different market by market. For example, in South Korea, the Kospi fell quite sharply in the early days of this conflict. Of course, markets in the Middle East, for example, in Dubai, have fallen more sharply as one would expect. But the big global equity markets, the US market, for example, has been quite resilient. And part of that is because some sectors are actually benefiting from this current situation. The large energy companies are big beneficiaries. So that's quite positive, given that the US has quite a large ecosystem of oil and gas companies. And of
Hmm.
course, defense manufacturing companies have also benefited in terms of their share price from this conflict. And the longer it goes on, the more orders they're going to get, replenishment of munitions and so on. So certain sectors have actually benefited. And in the US equity market, that's been important. But if inflation starts to rise because a wide range of products start to see price rises due to the higher input costs, then I think the risk is that central banks start to be concerned, start to signal that they might want to, raise rates. And that's actually what the situation is in Australia, where inflation pressures had already been a concern for the central bank, but now have intensified, which makes it much more likely that they'll raise again in the near future. These sort of pressures are obviously negative for equity markets if central banks are looking at rate hikes. And even in the US, where inflation had been relatively moderate prior to the conflict commencing, gasoline prices are rising and there'll be further increases in downstream prices. So at the very least, the Fed may not be in a position to consider easing anymore and may
Hmm.
be more worried about downstream inflation pressures coming in the pipeline in
Hmm.
so that changes the inflation outlook. And that in turn also weighs on equity markets if the outlook is for rising inflation. And we saw that very clearly in 2022 during the outbreak of the Ukraine-Russia war, when we saw a big increase in world energy prices, which hit equity markets, hit inflation, and resulted in some central banks all around the world raising rates. We're not in that situation yet with this current conflict, but if it becomes protracted, there is the risk that some version of that event may actually transpire again. So it's really vital, I think, for the global economy that some sort of resolution is found soon that allows the Strait of Hormuz to reopen. And I'm sure that there's many back channels that are currently being activated by many of the world's largest nations to try to influence the key protagonists in this conflict to try to find some way back to the negotiating table and try to find a ceasefire that will allow a resumption of normal oil and gas flows from the Middle East.
Let's talk about the countries in the GCC region, which up to now has been one of the most successful emerging market regions with rapid economic growth driven by oil and gas exports. But what are the implications of this protracted war on the future economic development of the GCC?
As you rightly say, the GCC has been one of the tremendous success stories of the last 20 or 30 years amongst all emerging markets. The GCC region, because of their oil and gas exports, have been able to drive very rapid economic development and have been also doing that in a way that's very peaceful and trying to maintain good relations with countries all around the world. And I would say, including with Iran, they've tried to maintain good relations. So I think there's quite a big shock in the GCC that Iran has been sending so many drones and missiles to attack GCC countries. So I think what we've seen is many years of very substantial economic progress, very big increases in living standards, and tremendous successes in countries like the UAE, Qatar, Saudi Arabia. They've built gleaming new cities, had tremendous improvements in living standards. And the question now is, will this conflict disrupt that pattern of economic development? And of course, a lot will depend on how long it continues. But in a situation where this ends within weeks or even perhaps several months, then I think the long-term development of GCC region should be able to resume. Clearly, there's been shocks to many sectors of the economy that will hurt the near-term growth in 2026. Tourism has been completely disrupted for a significant period of time. The airline industry, which is important for some of those countries, has also been heavily disrupted. And of course, exports of oil and gas have also been disrupted, which is fundamental for their fiscal revenues for most of those countries. So certainly for 2026, this is a very big negative dent to economic growth. If the conflict just continues to drag on, then that would be a very negative scenario for some sectors of the GCC economy because it would undermine confidence, at least in the near term, that these economies can see a recovery in areas like tourism and air transport.
What impact will this war have on the GCC's future developments in financial services, given the missile attacks from Iran and the tremendous disruption to air travel in recent weeks that we've seen?
Well, the GCC countries, and notably I would highlight Dubai, have become very important wealth management and financial services hubs, not only for the Middle East, but in the case of Dubai's International Financial Center, it's actually become one of the world's leading financial services hubs for wealth management. And that's been tied to the tremendous growth of the UAE population and the development of its property market for international investors. We've seen the population of the UAE growing from just around 2 million people back in 1990 to the situation in 2025 when it had exceeded 11 million people. And that's very dramatic population growth by any standards. And it's mainly due to immigration by expatriates, either people who have come as workers in many different industry sectors, or investors who have bought properties and have decided to live in Dubai, or of course there's other hubs in the GCC where they also have investors placing wealth management funds. If we just consider Dubai for a moment, it has assets under management that exceed 700 billion US dollars. And that's a very large amount of wealth management. And it's created a tremendous ecosystem of financial services firms, wealth management firms, hedge funds, and all of the other financial services support organizations that you would expect to find, accounting firms, legal firms. So that's in an industry in its own right that's been very important for the value added and economic development of the UAE. The question now is what will happen going forward? A lot of wealth was invested into the property market of Dubai over the last 30 years. If you go to Dubai, you'll see these endless numbers of very beautiful high-rise developments and also luxurious villas along the coast, which were not there 30 years ago to a large extent. So all of this new wealth has come into UAE, but how will that now be affected by the conflict? Obviously, up to now, the UAE and other countries like Qatar, Oman were very, very peaceful. And they really had never been involved in any kind of disagreement with Iran. I mean, there hadn't been really any exchange of attack or anything like that by Iran against these targets, except in a very limited way. We saw several episodes, but often they were deliberately low key so that it wouldn't really hurt the GCC countries. This time it's very different. If we just look at the situation in Dubai or the UAE generally, there's been hundreds of drones and missiles that have been directed by Iran towards UAE. And because the UAE has a very capable missile defense system, they've almost all been knocked out and intercepted. But nevertheless, when you have hundreds of these interceptions in the air, then the debris has been falling on buildings, on infrastructure, and there have been some deaths, unfortunately, in the UAE. Similar situation in other GCC countries where there have been Iranian drone and missile attacks. And they haven't retaliated. The GCC countries have wanted to try to keep the situation as stable as possible and are hoping that Iran will eventually desist from these attacks. And I think that's very wise because they don't want to, have an escalating confrontation with Iran, their close neighbor,
Right.
when for so many years it's been a peaceful coexistence that somehow managed to continue despite all the volatility and uncertainty in the region. How this will then affect the expat community, obviously in the short term, understandably, many expats may have chosen to return home temporarily, particularly if they've got family, they want them to be safe. That's completely understandable. But I think when we look forward, like how will this affect the wealth management sector or the property sector? Clearly, there's some negative impact in the near future as some of the investors become nervous. That means that there'll be less property purchases, obviously. I think we can expect that in the near term, there'll be a big slowdown in property purchases, and there may be some forced sales as well from investors who want to pull out. Similarly, in wealth management, there's some indications that perhaps some investors want to reposition to other financial centers. But I think if we take the long view and that this conflict will end in a matter of weeks or months, then I think the fundamentals of the GCC as wealth hubs, as centers for economic development will continue. I don't see that this temporary conflict will derail the GCC. I think they're going to be leading emerging markets globally over the next decade ahead and beyond. And, see the tremendous achievements of countries like the UAE, Saudi Arabia, Qatar in building these really state-of-the-art cities, very high living standards. I think there's a lot of capital that the sovereign wealth funds of the GCC have to support future economic development. And I think private investors will have their confidence eventually reestablished if they see peace continuing and that there's some sort of durable agreement that's reached between the US and Iran in the coming weeks or months.
In the event that it doesn't end soon and it does become more protracted, which other international financial centers could international investors turn to as an alternative from the GCC area and places like Dubai?
I think in a scenario which I think will be a low probability scenario that we see a protracted conflict continuing in the region, then of course that may dissuade at least some investors who had hoped to find a safe haven. Many of the investors in places like Dubai have actually fled from other war zones in the Middle East, the Ukraine-Russia war. We've seen many investors coming out of conflict zones to look for stability and peace. They don't want to be, again, living in a situation where missiles and drones are falling, in their vicinity. So it's possible a certain proportion of investors may decide to relocate elsewhere, or at least shift some of their wealth elsewhere to diversify their portfolios. And I think in that situation, it's the big international financial centers that for decades have been turned to by investors. And so in the Asia Pacific region, it's Singapore. Singapore has become one of the world's leading financial centers. It has a huge ecosystem of financial services and wealth management firms. The number of family offices in Singapore has grown very dramatically in the last 5 years. So that would be a clear alternative option for diversification of asset management, because many investors may not want to just completely leave, their current relationship in, say, Dubai, but they might want to diversify their portfolio so that spread across different hubs. And of course, the other favorite for generations has been Switzerland. Particularly Middle East investors have a very strong relationship with Switzerland for generations. Probably those two global international financial centers might be where investors turn to diversify their portfolios. Just in conclusion, I would again highlight that the most likely scenario is that eventually there has to be some sort of agreement between the US and Iran. It might take time to reach that, but the world can't operate without the oil and gas flows that come through the Strait of Hormuz. So there's a lot of pressure from countries all around the world for this conflict to end. Even, I think, within the Republican Party in the US, there's probably pressure on the Trump administration to end this conflict, because some of the MAGA supporters have always been very committed to focusing on the problems at home and not spending vast resources on international wars. So I think there's a lot of different pressure points that are pushing for some sort of resolution of this conflict. And so I think the most likely outcome is that we will see some sort of agreement relatively soon, whether it's weeks or months. And that will then, I think, allow the GCC to rebuild confidence in its countries and risk scenario outlooks. And I think that will, over time, result in basically the rebound of these economies in terms of the airlines, tourism, the property market, in terms of new investors coming back into property in the region, and of course, as wealth management hubs that are globally competitive. So I do have still a great deal of confidence in the outlook for the GCC countries.
Okay, well, very good. Well, thank you so much. I would like to thank Rajiv Biswas, CEO of Asia Pacific Economics, for sharing his insights today. I'd also like to thank our audience for joining our podcast. Please do click the subscribe button to join our Economic Roundtable events in the future. Asia Pacific Economics is an economic research and advisory firm providing world-class geopolitical, macroeconomic, and country risk analysis to businesses, governments, and international organizations. With a team of globally recognized experts, Asia Pacific Economics delivers actionable intelligence, evidence-based forecasts, and bespoke advisory solutions, empowering clients to navigate complexity and seize opportunities in the Asia Pacific region and worldwide. Find out more at asiapacificeconomics.com or email info@asiapacificeconomics.com.